Hello everyone, it's Friday, February 28, and today we will dive into the charts for the euro and the British pound to assess potential market movements. As you can see, pressure on the euro, pound sterling and other risky currencies has intensified. Yesterday, traders digested the US GDP growth data for the fourth quarter of 2024, which showed a 2.3% annualized expansion, largely in line with analyst expectations. Since the reading was not revised downward, it helped fuel the dollar's advance. However, the main catalyst for the dollar's strength was Donald Trump's remarks on trade tariffs, along with the release of the core U.S. personal consumption expenditures (PCE) price index. The core PCE climbed to 2.7% in the fourth quarter of 2024, surpassing a forecasted 2.5%, while the headline PCE inflation rate accelerated to 2.4% from 2.2%. This figure suggests further bullish movement for the greenback. Trump's comments about trade tariffs were pivotal in driving the dollar higher. They confirmed that his proposed 25% tariffs on Mexican and Canadian goods would take effect on March 4, along with the extra 10% duty on Chinese imports. In addition, he stated that tariffs on major trading partners, which he had threatened earlier this month, were scheduled to take effect on April 2. This news weighed heavily on global markets, leading to sell-offs in risky assets. Despite expectations of further interest rate cuts by the Federal Reserve, demand for the US dollar remains strong. Furthermore, recent projections point to stronger inflation in the first quarter of 2024, with dollar buys already pricing in the expectation. Now let's take a look at today's macroeconomic calendar, which includes a batch of important data from the euro area. Among the key reports are GDP growth figures and consumer price data from France, and well as Germany's unemployment rate and inflation, which is expected to show a 0.4% increase for February. If the results disappoint, the euro could face additional downward pressure. However, the forecasts are largely optimistic, which may provide some support for the currency. Later in the day, attention will shift to US data, particularly the core PCE price index, the Federal Reserve's preferred inflation gauge. The index is estimated to have risen by 0.3% month-on-month in January and 2.6% year-on-year, compared to December's 0.2% and 2.8% respectively. Stronger than expected readings would signal heightened inflationary pressures, potentially prompting the Fed to halt its current rate-cutting cycle. Notably, the U.S. economy showed early signs of slowing growth requires stimulatory measures. Keeping interest rates high combined with Trump's aggressive policies is not the outlook that traders expect. However, if inflation picks up again, which is highly likely, Fed policymakers will hardly be in a hurry to ease monetary policy. Furthermore, data on personal income and spending on the U.S. is scheduled for release today. According to forecasts, consumers curtailed their spending in January, which could help partially offset higher inflation. If personal income exceeds expectation, price pressures may remain again elevated. Turning to technical analysis, the 1-hour EUR USD short pair has collapsed sharply. Given the lack of any signs of a correction in sight, it is advisable to avoid jumping into long position just yet. Buyers are likely to regain control of the market around 1.0375. A false breakout at this level will trigger a buy signal, with the euro recovering to 1.0404. If the price breaks above this mark, the European currency could rally to 0.430, potentially reaching 0.460. At this mark, I would recommend going short on the rebound, expecting a 25-30p move. Short positions at 0.404 and 0.430 should be considered on a false breakout. Alternatively, if the price breaks below 0.375, the euro could extend losses to 0.349 and probably 0.321. At this level, it would be wise to go long on a rebound, counting on an intraday correction of 25-30 pips. Going long at 0.3 49 and 0375 would only be relevant in the case of a false breakout. Speaking of the British pound, its bearish scenario correction appears less pronounced than is in the euro, as investors in the latter end rattled by Trump's trade tariffs. Therefore, long positions might be considered at the support level at 1.2563. A false breakout here would push the price back to 2607. A break above this level would make it possible to add long positions, expecting a further rise to 2642 and 2680, as well as a return to the sideways range. Short positions at 2642 and 2607 would be advisable only in a false breakout. Long positions on a rebound should be opened at 2680 in anticipation of a 30-35 pip move. However, if bulls activity remains subdued and the price breaks below 2563, the pound sterling could dive to 2524 and even 2480. At this level, traders are advised to go long on a rebound, expecting an intraday correction of 25-30 pips. Going long at 25.24 and 25.63 would be only prudent on the false breakout. Good luck to all.